Let us solve some recent ICAI questions of capital structure. Sum number 1, this question was asked in December 2021 for 10 marks. Earning before interest and taxes of the company are 4,50,000. This is the EBIT. Currently, the company has 80,000 equity shares of 10 each, retain earning of 12 lakhs. It pays annual interest of 1,20,000 on 12% debentures. We can easily find out face value of debentures. The company proposes to take up expansion scheme for which it needs additional funds of rupees 6 lakhs. It is anticipated that after expansion, the company will be able to achieve the same rate of return on investment as present. So ROCE or R will be same. It can raise fund either through debts at the rate of 12% per annum or by issuing equity shares at par. Tax rate is 40%. So additional debt can also be raised at the rate of 12%. Compute the earning per share if the additional funds were raised through debt. The additional funds were issued by equity shares. Advise whether the company should go for expansion plan. So please understand, if I want to suggest company whether it should go for expansion plan or not, I'll have to also find out current EPS. And if my proposed EPS is not higher, I will advise the company not to go for expansion plan. And which source of finance should be preferred. So I will be finding out EPS under current scenario. I will be finding out EPS under option number 1. I will be finding out EPS under option number 2, and I'll be getting the answer. Let me first have a basic understanding. Let us first calculate how much currently is capital employed. Currently, capital employed currently the company has 80,000 equity shares of rupees 10 each, that is 8 lakhs rupees equity share capital. Retain earning of 12 lakhs. And 12% debt which is paying interest of 1,20,000. So debt answer will be 1,20,000 divided by 12%. It is paying interest of 1,20,000 at 12%. So what will be the base value? 1,20,000 divided by 12%, which is 10 lakhs rupees. Total capital employed will be 30 lakhs rupees. I am also finding out R or ROCE, return on capital employed. EBIT divided by capital employed. What is current EBIT is 4,50,000 divided by 30 lakhs multiplied by 100, which is nothing but 15%. So current R is 15%. Try to understand proposed situation. If in proposed situation, I go for option number 1 or option number 2, under both cases, my current capital employed is 30 lakhs and additional 6 lakhs rupees will be raised either through equity or through debt, but ultimately only 6 lakhs rupees will be raised. So my capital employed will be 36 lakhs rupees. And try to understand what the question says. Question says that it will be able to achieve the same rate of return on investment at present. So I will be earning EBIT of 36 lakhs multiplied by 15%, which 15%, same level of rate of return I am earning. which will be nothing but 36 lakhs into 15%, that is 5,40,000. This will be new EBIT. So if you are going for expansion plan, your EBIT will be 5,40,000, earning 15% rate of return. And if you are not going for additional plan, your EBIT will remain 4,50,000. So I have got in proposed EBIT, and in present EBIT is already given. The company will be able to, it can achieve 12%, so additional will be 12%. Additional funds were raised through debt. So in option number 1, the 6 lakhs rupees are debt at the rate of 12%. And in option number 2, the 6 lakhs rupees are equity share capital at the rate of rupees 10. Alright, so let me find out the answers. I will be doing directly in Excel sheet, and it will be easy for me. Even in examination it is time consuming, but the question is extremely easy. So let me first input in current system. Total capital is 30 lakhs. What is current equity? Current equity is 12 plus 8. Retained earnings is a part of equity. It is not a part of debt. 12 plus 8 is 20. And so 10 lakhs will automatically be debt. What are taxes? Taxes are 40%. What is EBIT in current situation? EBIT in current situation is 4,50,000. Let me find out interest in current situation. Interest in current situation, I think it is already given, 1,20,000. Interest will be 1,20,000. And if I write down even 12% over here, cost of debt is nothing but 12%. I will be directly getting EBIT minus interest is EBT minus taxes at the rate of 40% is nothing but EAT. Number of shares, how many number of shares will be there? How much equity share capital is there? 8 lakhs. And it is given that they are of 10 each. So there will be 80,000 number of equity shares. Number of equity shares will be 80,000 in current situation. And I will be getting answer of EPS, which is 2.475. Let me go to proposed situation. Total capital is now changed to 36 lakhs. So total capital is not 30 lakhs, it is 36 lakhs. In option number 1, 6 lakhs additional finance is through debt. So equity will remain same, which will be 20 lakhs. If equity is 20 lakhs, debt will be 16 lakhs. How 16 lakhs? Original debt was 10 lakhs plus new debt is 6 lakhs. So total is 16 lakhs, and it will be charged at 12% interest. So my interest will be 16 into 12%, which is 1,92,000. Under proposal number 1,92,000. It is not 19,20,000. my EBIT will change. It will not remain 4,50,000. EBIT, new EBIT is 5,40,000. So if you will see, my ROCE is remaining same. This we have found out. We have found out 5,40,000 by same thing. Interest in proposed case is 1,92,000 in first case. Option number 1. And number of shares, as additional 6 lakhs rupees is issued through debt, number of shares will remain same, will be 80,000. And so my EPS will be 2.61. EPS will be 2.61. I am going to proposal number 2. Total capital will remain same, that is 36 lakhs. My equity, now equity will change. How it will change? First there was 20 lakhs rupees equity, and in option number 2, 6 lakhs rupees equity has increased. So equity will be 26 lakhs and debt will remain 10 lakhs. And the total capital employed will be 36 lakhs. So what will be equity portion will be 26 lakhs. Other all things are remaining same. Interest will remain 1,20,000 original interest, because new 6 lakhs rupees is not issued through debt, is issued through equity. So 1,20,000 as in original case will be my interest. Number of shares. How many original number of shares were there? 80,000. Those are original shares. How many new shares will be issued to issue this 6 lakhs rupees? Because they are issued at par, more 60,000 shares will be issued. 1,40,000. 1,40,000 rupees new shares will be total shares will be issued. 80,000 original plus 60,000 new shares. So new number of shares will be 1,40,000. And I am getting my answer of EPS, which is 1.8. What is the EPS in answer number 1? Is 2.475, which is original situation. What is the EPS in answer option number 1? This is 100% debt, and so this is risky option, which is 2.61, which is higher than present. So you should always go for expansion, because your proposed situation is generating higher EPS. And proposal number 2 is having EPS of 1.8. And so we will go for proposal number 1, which was higher risky because it was having higher debt, with a EPS of 2.61. And please try to understand, I could have found out easily without even calculating. As you are doing this in examination, you should calculate it, but understand the concept of trading on equity or leverage effect. If you increase the debt proportion in your capital structure, and you are having a favorable leverage, your value of EPS will always increase, and PE ratio being constant, your value of MPS will also increase. So if there is a favorable leverage, when there is a favorable leverage, when R is greater than KD, which is true in this situation. Your R is 15% in present as well as proposed, and your KD is 12%. If there is a favorable leverage, you should increase the debt proportion in your capital structure. In which option we are increasing the debt proportion in capital structure? In proposal number 1. Believe me, EPS will be higher. Without calculating, I can say EPS will be higher in proposal number 1 as compared to proposal number 2. And PE ratio being constant, even NPS will be higher in proposal number 1. Yes, if there is a change in PE ratio because of risk, then the answer might change. But if PE ratio is constant, then even NPS will be higher in the situation where there is a higher debt whenever there is a favorable leverage. So this is trading on equity. You can always write this down in your conclusion of your answer.